Hey guys, welcome back to the channel. Today we've got a special guest on again. We've got Cathy from Property Sharemarket Economics. You know that I've had her on the channel a few times before to discuss the property cycle, what's going on in the real estate market, land in particular, the economics that's going on in Australia and overseas, because that's what the company does. Property Sharemarket Economics looks at the overall 18.6 year cycle. And you know that I reference this little book back here quite often, which we'll look at during the stream, basically looking at the cycle, which is going to lead us into the peak of the stock and real estate market. So Cathy, thank you once again for joining us here on the channel to explain and decrypt everything that's going on out there.
Yes, thanks, Jason. And when you said the real estate market, I thought you were going to say the real economy, what's really, really going on out there amongst all the crap that we hear and see. So
I'd love to hear about that as well.
Yeah, let's get into it.
All right. You guys know what to do. If you find value, hit that like button down below, subscribe. And Cathy's also got their YouTube channel, Property Sharemarket Economics, which you guys can follow. I'll leave a link to that in the description down below. So they cover the 18-year cycle, hitting the mark every single time. So let's dive into the first piece, property. We can dispel the myths and then dive into the real market going on. So what are we seeing at the moment? What's where are we at in the cycle first, and maybe just touch on the cycle, because you've got some slides there that people are unfamiliar with the cycle.
I want to show this one first, Jason, because it is the shape of the 18.6 year cycle. On average, it goes from 18.6 years. Mm-hmm. And a very quick recap is the beginning of the cycle, a 7-year expansion into a mid-cycle peak, and then into a mid-cycle slowdown, and then a second, on average, 7 years expansion into the ultimate peak, and then a major crash. And it's a land-led crash. So it's a land-led value recession. And when I say land-led, it's because the US land values is what leads the cycle. US land values peak at the end of the cycle and then start to plummet down for around 4 years. So I've got the previous cycle years up until the end of World War II. So you've got the 1955, 1974, 1993, and then the last cycle, 2011, when our current cycle started. Note I've got 2020. Mm. And being this is where we are, 2020 and 2021, we're in a mid-cycle slowdown. The type of slowdown and recession that punctuates the middle of this 18.6 year cycle. This is where we are right now. So I'll go to the next slide. It might just show it a little bit easier. There's our 2020 peak, and this is where we are right now, and then the second part. So I want to talk about right now. That's your question. Where are we now? And we're mid of this cycle. When in the mid of the 18.6 year cycle, it's a confusing time for people, because yes, in some cycles there's a recession. In other cycles, it's a slowdown. In Australia, it's not necessarily a recession, but in this particular one, it has been pretty well in most Western countries. And it's not land price led. So real estate prices may slow down, they may go sideways, but they don't necessarily have a decline. And that's what's happened. And in fact, what has occurred, because we're now coming to the end of this current mid slowdown, recession period, we're seeing in Australia just a massive takeoff in property prices. Now, not everywhere, mind you. You still need to choose, the right location, the right type of property. But what's occurring now is speculation in land prices. Hence why you've got regional areas that are now really lifting in prices. And the listeners, you might say, well, it's because of the pandemic. It's because people are moving out of cities into country areas. If you go back in history, in every second half of the cycle, regional areas and coastal areas have always started to lift in prices in this second phase. Always have. It's because speculation kicks in to a much greater degree in the second half of the cycle. So all of this was due to occur, pandemic or not. It was due to occur. Now, the pandemic has created more fear. Granted, it's created more fear. Hence the massive 40% panic decline in last March, and this then bounce off with recovery in the share market from there. It's all fear-based. And that's created a little bit more of a panicky situation, but this is not anything out of the ordinary to what's occurred historically.
Right. So essentially, this is all just a repeat. It's not exactly the same in terms of what has caused it, but the cycle is pretty much on track. And so whenever we see stuff around double dip recessions, money printing, all these other bits and pieces, bond yields, etc., it's all just part of this cycle turning. And this is the beginning of the second stage, the second expansion phase. And we are seeing signs of that now. So we're not going to be getting any sort of double dip. Property prices aren't coming down in 2021, nor are they coming down in 2022, 23, 24. This is just going on and on and on until we hit around 2026.
Yeah, yes, a good summary. There's a few things there. We are expecting this to go up into 2026. Now, this 2026 timeframe is where we believe what's likely to occur is US land values to top in the year 2026. Okay,
we'll know a bit closer to that date. We'll know whether it's the beginning of the year or end of the year. Yeah. So we're still about 5 years away from that.
Yeah, we have an idea of when we think. Now, that doesn't mean that the share market's going to peak in 2026. Okay. But what it does mean is that after 2026, US land values will start to come down. The share market will probably still be on its way up, and we're looking at a peak in the US share market around the 2027 mark. Again, we'll know more about that as we get closer to it. But it's the beginning. It's the beginning of this massive, really scary downturn. But we're not near that yet, right? So
we've got big growth to come.
So that's right. So in terms of Australia, yes, we will continue to see this going up. There'll be volatility around, no doubt.
Sure.
No doubt. And I do think that in 2024 we will see some kind of little bit of a decline and some kind of might be a little bit of a panic, a little bit of an upset in 2024, 2025, but nothing that's going to stop
the first sort of shakeout. The first sort of shakeout before we get into that final winner's curse phase. I
think will be around 2024, early 2025.
All right. Any reason for that?
Yes, good question. Look, in Australia, and perhaps I'll stop sharing my screen now. In Australia, Melbourne and Sydney, they tend to have this 7-year peak to peak in property prices. 7-year peak to peak to peak. Now, if history is to repeat, that next peak, that next top before some kind of sideways action or small decline is 2024, the latter half of 2024. Now, the other thing is it's also the beginning of let me share my screen again, the beginning of the winner's curse phase.
Yeah.
And this winner's curse phase here. So you'd start to see volatility and then a major zoom up after 2024. So it's coinciding with that, but it doesn't mean it's the end. It's just really the bit of volatility. You know, you've got to have some kind of breakdown before the last zoom up into the final growth period.
Yeah, I can see it with the emotions of the investors where we've come into this. We've had such a good run for 3-4 years. Then you've got to have some sort of shakeout into the final top, whether it's a higher top or an equal top or a slightly lower top in terms of pricing. And that gives people that extra hope to think, wow, this thing is really not going to end. And then we get the end because everyone is piled in. It happened the same pretty much every cycle I can remember or have studied.
Yes, that's right. And you know, even for guys out there watching this, if you just go back to the previous cycle, if you go back to 2004, 5, 6, and 7, you'll see exactly that. You'll see this.
I was working in real estate at that time, and I remember I was only 19, 20, and the guys in the office, you know, 30, 35, selling real estate, like, yeah, this thing's not going to end. It's all sold, blah, blah, blah. Just, you know, now you got to buy, otherwise you'll never be able to afford a property again. And, you know, obviously we know history shows us cycle ended, but in Australia, we were so in a cocoon here that our property prices basically stagnated just with the mining boom, whereas everywhere else just got destroyed. And so looking at commodity cycles as well, which we might get into, but I think we want to just chat about just cover some of the other myths where, you know, people are a lot of talking about bonds got to do this, job keepers got to do that. But all I was going to get to is in the commodity cycles, that is also peaking at around the same time as the property cycle, the land cycle. So before we get into that, do you know much, you know, shall we chat a little bit about the yields and the bonds increasing, how that affects the cycle? Or why?
Look, it's just some normalizing, you know, it's nothing to worry about. It's just some normalizing. Now you mentioned, you know, money printing. It's money creation.
Interest rates increasing.
Yeah, but it's the creation of money within the system. You know, you've got the Reserve Bank of Australia buying government bonds. You know, it's just the Reserve Bank of Australia and the federal government, they're one of the same. It's just conflated, you know, they're not two separate entities, they're just really one and the same. It's in countries that have their own currency, like Australia, those countries can create their own money. They just create it, and they can then flow it into the community. Now that's a really good thing to occur when there's times in the economy where we really need it, like recessions, you know, what we're going through, with unemployment being high, so full employment being low. It's important that these sovereign countries with their sovereign currency can create it and put it into the system. That's a really good thing. It doesn't mean there's going to be inflation. Let's get clear on this. The only time that inflation will actually start to kick in is when the money flow outweighs the production. So at the moment, the money, let me say that again, when the production outweighs the money flow, okay? That's so at the moment, production's low because unemployment is high.
Yeah.
That's why we need money flow into the system. Now, when production starts to become greater than the amount of money that's in the system, then we'll get inflation. And that's what's happening now. That's not what's happening. So
at what point do we see that? What are the signals that we genuinely see when production grows so much that it outweighs the money inflow?
Yeah. Just look at employment figures.
Employment figures, all right.
Yeah. So
and
when
right now, employment figures are okay.
Yeah. Well, employment, we're still really, our unemployment figures are still high. Okay, so whilst they're still high, this money creation and going into the system is a good thing because it's to be used for production. Right.
So then the unemployment drops. If we're still printing too much money, production then increases too far. We get the inflation. The rest is history.
Yes. Okay. One more thing to add to that.
Yeah.
The only way we'll get inflation is if taxes are not increased to balance up money flow and production. Okay, so if taxes aren't increased to stop the flow into the system, to stop people spending money, if that doesn't occur to keep that balance between money flow and production, we will get inflation. Okay.
So yeah, it's inevitable that taxes are going to increase with this money printing. At what point we have to figure that one out.
That's right.
How does that then weigh into credit creation? Because obviously that is a big driver for the land cycle. and for the prices of land and
Yes.
real estate to increase?
Yeah, good question. Now, I'm hoping I can explain this really easily.
You will.
The majority of credit that's created by banks, because banks create credit. They don't loan things out, they create credit. The majority of credit creation that banks focus on is for the purchase of land. So I'm talking about there's land and then there's the house on top. Okay, so people think I just buy one thing. Well, you're actually buying two things. You're buying land and the house on top. Now, in relation to inflation,
you're buying a depreciating asset, which is the physical structure, and then you're buying an appreciating commodity, which is the land. And so when the banks lend, yes,
they're lending towards both. So you've got it's exactly right. The building's depreciating, the land is appreciating. Now, when you relate it to inflation, when you relate it to that, in our current economic system, land prices are not included in the analysis of our economy. It's not, land prices are not included. The building on top is, the depreciating asset on top is included, but not the land. So a simple test of that, go to how the CPI is assessed and calculated. It's all about construction. It's nothing to do with land. They do not include the price of land and how land is inflating in value within the figures. And so more credit continues to be created, land prices continue to go up, and it is all warped. It doesn't make sense, but that will continue to occur until it doesn't, and that will be after 2026.
That's where we get the peak. So ton of credit is continue to be created because we are continuing to try and boost the production, and then the production is the house itself.
Yes.
Yeah.
Yes,
and because
right.
that keeps depreciating, we can keep printing more money, but unfortunately the depreciating asset is sitting on top of an appreciating asset. Well, it's actually a depreciating liability, but the asset continues to go up as well because people need the land in order to be productive on the land. And so the production increases the value of the land.
Yes, that's right. That's exactly right. I think if there's one thing that our listeners can try to understand is that land is treated very differently to the building on top. And if we can really see that there's a difference between the two, you'll start to understand why these cycles occur and how warped it really is, and why at the end of the cycle it's such a massive destructive decline in a much bigger way to what happens in the mid-cycle.
All right, so we've basically covered the hows and the whys as opposed to looking directly at all of the small detail of the bonds increasing and the yield curves are doing this and all these other little things which just distract people from
smoke and mirrors.
Because and I mean people will probably take offense to that because it's the main thing that everyone looks at. But I guess my reasoning to that is that those figures continue to change, or at least the way that we interpret that data. And so one time it does this, the next time it does that. There's no consistency really. People can pull consistency from it, but at the end of the day, the real reason is the creation of credit from the banks.
That's exactly right. Look, journalists, and I'm not putting anyone down here, but I am, I suppose. But journalists have to create headlines for us to read their story. And
I do the same thing on YouTube, and I hope to give information underneath all of those headlines. So,
gosh, it confuses people, doesn't it? And especially
it sure does,
especially if the information that's then being provided is just not accurate. It's just creating a drama and upset and fear. And the thing about understanding this 18.6 year cycle and where credit relates to it and where land relates to it.
That one. Yeah.
The thing about understanding that.
A link to that in the description. It sounds like we're holding up our Bibles and we've got to do some Bible bashing, telling people to get that.
Yeah. The link to understanding that means, and I'll keep holding this up also, is that you don't have to be wrapped up in this emotional roller coaster ride, trying to understand.
Trying to bring all
the
these
problem
pieces of the puzzles together, and then how does the puzzle change and move, and this time is different. So let's move on to some of the other pieces that tend to come up in the Aussie economy, and then we'll also we'll go into US stuff as well, because that's primarily what the cycle is based on, because the US is the biggest economy, which then obviously drives everything else. We've all heard the saying that if the US sneezes, everyone else catches a cold. But let's start with the little things in Australia. And I call them little things because everyone's hyping them up. JobKeeper ending end of March, I think it is. I don't know whether they're getting any extensions on any of this stuff. Does that really matter? We obviously know the answer is no, but why and how and etc. Go on.
The airline industry, their job seeker support, they're getting an extension with the airline industry. I do understand that. I can't see there being a major issue occurring in the economy just because job seeker or job keepers ending.
Why?
They're not. Look, do you know how much? Do you know the number of extra deposits that our Australian population have made in the last 12 months?
Go on. I don't.
115 billion.
How?
There's an extra. How?
Yeah.
I think it relates to the 140 billion in job keeper payments, job seeker payments. What it's done, it's created people to actually save money, actually have more money for themselves, an extra 115 billion.
So that couldn't be all JobKeeper. I guess if we're all locked down, then we don't have much to spend on. And you guys, unfortunately, in Victoria, Melbourne, locked down for 6 months. You can't spend your money on anything.
Well, there's you should have seen the amount of courier vans going past my street every day. People were having
online,
things delivered.
Yeah,
online. So yeah, people were still spending. You can't say they weren't. They absolutely were. We're a strong economy. Really, we're not a third world country. We are a strong economy, and we do have a government that has been creating this money and putting it into our economy, enabling people to save or spend. So no, I don't think much is going to happen in terms of a collapse once JobKeeper or job seeker ends. That is not going to occur.
Right, because the main thing people say to that is, or analysts, economists say that, well, if JobKeeper is ending, then there's going to be backlogs on people's mortgages, on their rent payments, which then leads to the mortgages. No one can pay their mortgages, and they've got to be repossessed, and then that's going to lead to a oversupply on the markets, etc.
But they were saying all of this in 2020.
That's true.
The same argument was occurring in 2020. So
yep.
and that didn't happen. So no.
Well, JobKeeper was there.
And that's right. And they were still saying that people aren't going to be being able to pay for their rents. They were still saying all of those things. So they're saying the same thing for two different arguments. It doesn't stack up. Now, production is increasing in the Australian economy. We do have unemployment lower, so that is occurring. So we are moving towards a higher or more productive economy. That is occurring, not in any fast way, but that is occurring. So
what about what about the unemployment figures when they pull them from different areas and change the way that the employment figures are calculated? It's still on the increase.
Still on the increase, and
right.
And you've just said something there, Jason. That's the other thing. When you're looking at these statistics and these figures, where do they get them from? And figures can be construed to answer any kind of question, to create the answer that you want.
Sure,
really.
Depending on who wants to win that argument.
That's exactly right, which is why I come back to this 18.6-year cycle, because it's been in existence for over 200 years. And it is occurring like clockwork. It's not faltering. So use that as your framework. Use that, and not all the other economic data that just confuses us. Use the framework.
Gotcha. Easy said, done. Read the book. We've talked about it heaps of times. I have a link to that book in the description and almost every single one of my videos. So yeah, check that out. Let's now chat about, say, the rest of the world and interest rates. Because I think there was some talk yesterday about interest rates going up in Australia. I think this is all part of the cycle again. The US has also talked about it going up, not next year, but possibly in 2023. Is that going to then lead to the crash earlier?
Okay. So interest rates, when you break it down, interest rates are simply a cost of credit. It's just a cost of credit. It's your expense. You know, what if you want to get your hands on 500K, well, your expense to doing that is what an interest rate is. It's just a cost of credit. Now,
and right now it's cheap to get that.
Yeah.
To get your 500 grand, it's costs you nothing. But then if it goes up to 1, 2, maybe 3%, it's going to cost us a hell of a lot more.
Yeah.
Which then leads to people not being able to afford that because wages haven't gone up.
Well, I'm just going to share my screen again and go back to here. Remember the 80s? No, you won't remember the 80s. You're too young.
I was born in the 80s.
The 80s.
Yeah, no.
I remember the 80s. And I remember the late 80s, early 90s. I was a young police officer at that time. And, you know, I was so, I felt comforted that I had a government job in the early 90s because interest rates were at 17 and 18%. The cost of credit was at 17 and 18%. The unemployment rate was, I think, around 9%, but I please don't quote me on that. I think it was around 9%.
It was high, yeah.
It was high. But what also was happening, you know, land prices, you know, skyrocketing. And in the early 90s, they did have a dip. But prior to that, interest rates, you know, going 8, 9, 10, 11, 12, 13, 14, 15, 17, 18%. It's just the cost of credit. Now, at the end of every cycle leading into this winner's curse phase, interest rates do start to come up. That is one of the leading indicators.
So that's due around 2023, 2024.
2025. I'd say 2024, 2025, 2026, around.
For the interest rates to start increasing. We might get a few little creep ups.
Yes, for it to matter.
Right.
It really starts to lift up towards the end of the cycle. If we get interest rates increasing, you know, in next year, 2023, 2024, it's not the collapse. It is not the collapse. It's just a way of managing the creation and flow of money. That's it.
Okay.
It's not a collapse.
All right. So you're telling us about your police officer story in the 80s and the property prices were going up. That was we had high interest rates at that time, but it didn't start from a base of zero either. So the main point there is that interest rates can increase, but that usually happens towards the end of the cycle in a significant way, which then leads to the crash. So the first signs of it are letting us know that we're getting closer, but we could be a couple of years away from it.
Oh, absolutely. Right.
Yeah,
yes,
it's not going to be...
it's going to confuse a lot of people. And this is what's going to happen.
Right. You know, so we're going to see those headlines out at that time. And it's going to be, again, the stock market, the property market crash of 2022, the property market crash of 2023. And it's going to keep going and going till we actually get there.
Yeah. And it never happens. And because it doesn't happen towards the end of the cycle, when economy's pumping and there's high employment, you know, the production's really pumping and you've got land values that are just out of this world. But because there was no collapse in the years leading up to that, when they said there was and then there wasn't, you'll have the same conversations that you had, Jason, going into the GFC. Oh, we're never going to have another bust. It's just going to keep going. The government's done such a great job. Bank's doing such a great job. It's just going to keep going.
I hope, I know it won't happen, but I hope that some people who are at least watching this will remember the same emotions, say, from the crypto cycles, because it was the same conversations in 2017. This time it's different. crypto has to go on this bigger run. The bigger money's coming in. It crashed. We're in 2021 now. The cycle is crushing it. We're going up triple digits over and over again. The institutional money's coming in. We're having a super cycle. We're having a massive hype cycle. We're doing an S curve. We're never coming down from this point because it's not meant to be, so it's the same stuff, but at least we're seeing it more regularly now, especially with the viewers here who are, I do a lot more on cryptocurrency on the channel as opposed to real estate cycles. So take that. All my lesson is here is take the emotional side that you see from crypto more often and then apply it to the stock market or the real estate market, because we will see the exact same emotions happen again.
Yes, it's the stock market, the real estate market. It's the whole, it's everything that makes up the economy.
Uh-huh.
It really does. And to be philosophical about it, or it's not even philosophical, to be real about it, nothing ever goes up without coming down. It has to come down before it can have the next growth spurt. That's reality. We're part of nature. That's life, But what we want to know is, when is it going to come down? And that's what we specialize in. When's it going to come down?
Yeah, because you could say, well, we've had a pretty good run out of 2020 or even 2019. The markets here have done very, very well. It's like, at what point do you sell out and you sort of miss that last part of the run? Because once the prices on anything come back down, maybe they only ever come back to that level that you sold out at. So you're not really making anything. So to understand this framework for the land cycle, at least you can get the vast majority, what we know of as being the lion's share of the cut, and sell, and then have some cash on the sidelines to reinvest. We're never going to pick the exact top, but I think we can get very, very close to it with this 18-year cycle.
Yes, you're right, Jason. We don't want to pick the top. And in fact, if you're in early enough, you don't need to pick the top.
Exactly. I did that with Bitcoin, Ethereum. It's just buying in the accumulation stage, then just ride it out.
Yes.
Ride it out.
Yes. You got to follow the trend for sure. But you've got to be open-minded enough and objective enough and unemotional enough to identify when the trend has changed. And that can be hard when everyone's saying the opposite.
Definitely, especially with what I'm sure we will see in that 2025, 2026, as I remember from 2006, 7, nuts. Absolutely crazy.
Yes.
The last bits and pieces before we sort of wrap it up, but I want to get into, say, the US or the UK market. Does this all sort of apply to that? Because the similar questions that I get in the comments are, my town of some random place, even in Australia, some random small town, we're going down. Or it's where Northern Territory, someone commented like, we're going up so much. Or, generally speaking, US, UK, very similar to Australia. Or Australia is very similar to them, I should say.
Australia is similar to them. So US is the largest economy in the world. The US does lead the overall world economy. And I'm thinking China here. Once China really becomes part of the Western world's financial system, then there'll be similar timings. But at the moment, US is still the largest economy. So the US leads this, and UK follows the US. The UK land prices also follow the US land prices quite closely. Australia's land prices, we have our own cycle, but at the end of the day, when the US economy made up of land, share market, jobs, when that comes crashing down, we all have to follow. We all do. We follow. We cannot go opposite to whatever's happening in the US.
Yeah, so that's why we follow the US first and foremost, and then pick our areas that we're interested in. Like I'm on the Gold Coast, so I choose this market. Same with Brisbane, and I just have to get a little bit more in tune with this market because it moves a slightly different timing, but overall, grand scheme of things, is into mid 2020s. Yeah,
yes.
We're on the money.
Yes,
on the money there.
Yes, that's right. Yeah, look, the same. You still get the same in terms of from an investment perspective. Choosing location and type, you still got to make sure you have your strict criteria as an investor. You can't get away from that. You can't, you know, don't make a silly decision because you think it's just everything's going to go up. It still has to be sound, and the figures, the numbers have to all stack up.
Got to get our feasibilities done. It's same sort of thing. Don't be buying inner city apartments in Sydney, Melbourne, any of that sort of stuff, which is just sort of, there's so much there. Sure, they might go up, but your money may and probably will be better off elsewhere to get better returns. Do you want to just show your slide one last time, and we'll wrap up just to say where we are, where we're going, just as one final summary. And while you do that, I'll just mention Property Sharemarket Economics. You can get a link to their YouTube channel down below. But essentially, you guys follow this. I mean, I've been following you guys for a couple of years now, and Phil for almost 10 years. Phil is the co-founder with yourself at Property Sharemarket Economics.
Yes, and Akhil Patel, who is based in...
I always leave him on. He's great.
Yeah,
he's based
in the UK. He's absolutely amazing. Just as good as Phil in terms of his understanding of history and applying it to now and to the future. He really is amazing.
So with people to follow you, then they're going to have a better understanding of how this works, the signs to look for, how to control their emotions, because you can basically put all of the news that's coming out together in a simple plan.
Yes, yeah. We do a monthly newsletter. It's called the Boom Bust Bulletin, and that's only $47 a year. And that can
easy entry point.
It's a really good entry point, and it will keep you just understanding where we are within the cycle from that more overarching side of things. You're a member of the more in-depth service, Jason, and so that's when you get all our more micro forecasts. But from an entry perspective, the Boom Bust Bulletin really is a good one to do.
Yeah, good starting point. So they can find a link to that in your YouTube videos.
Yes.
Yeah.
Yes,
okay.
Yes.
Good. Because this is like I said, I've been following it for years. I'm not going to bang on about it too much more because I do that in every other video, but it's very easy to understand once you get the hang of this. Okay, so let's go with a final summary. We are here. Where to next? Next sign, and then we'll wrap it up.
Yes. Okay. Expect some volatility this year in the share market. Just expect
and the US stock market.
US stock market, Australian stock market. Just expect some volatility. It's just going to come, you know, and there's reasons for that. But we won't talk about that now. Just know it's going to come. But it's not going to stop this from occurring. I hope you can see my arrow. So just understand that we are, don't be scared of these asset values that are going crazy. Don't be scared of that. It doesn't mean a crash is around the corner. Okay, it's part of what's meant to happen. It's what's meant to happen.
It will. So the valuations of these companies can get even more extreme, more crazy. Their PE ratios are going to be way out of the waters. Looking at property prices, say for Australia, because I've got a lot of Australian viewers, we've been really hot for the last 6 months, since about August. Can this keep going this year? Or are we going to maybe cool off? Not drop, but at least not be going up 20% every 6 months. We've gone up a lot here.
Yeah, just bring it back to normal growth. Just bring it back to understanding about the seasons. Just the seasons in nature. Seriously, it's as simple as that. You know, in winter you have some decline to get ready for what happens after winter.
Winter, we got spring, so that's when the property prices,
growth, and then you got summer, which is crazy. And then you got autumn decline. It's the same type of thing. There will be some cooling off. I doubt there'll be a decline. Not when we know credit is going to be expanding.
Yeah, and that's coming this year or next year, I think.
That's absolutely. It's actually going through the Senate right now about the responsible lending laws. It's being heard again in June. So
let's touch on that in the next videos, because we can go into more credit then. But we're at this. This is the point. Heading up. It
will cool off, Jason, but it won't decline.
Right. That's where we are now. Let's catch up again, say like a month's time. If you guys have questions for your areas, not specifically the areas, but the overall cycle where we are, if you've got some concerns about the news that's out there, all the stuff that we keep hearing about bonds and double dips and all this sort of stuff, Leave your questions down below. Go follow Cathy on Property Sharemarket Economics YouTube channel. Check out the Boom Bust Bulletin as well. Very easy entry point to understand these cycles. You'll receive monthly newsletters on that. And stick around on the channel. Like the video if you found some value from it over here. Subscribe to the channel. Bell notification icon. We'll see you guys at the next video. Thanks again, Cathy.
Thank you, Jason. Thank you, everyone.
Cheers again. All right. Have a great one, guys. See you at the next one. Peace out.